Hey, good morning, options traders, and welcome back, everyone. Well, last week we had an interesting question from one of our traders asking about the cost of exercising a put option early. And it's a good question. It comes up a lot, the whole idea of early exercise, whether we're talking about calls or puts. So for today, let's just focus on put options. Should you exercise put options early? What's the benefit, and under what conditions does it make sense? So for early exercise of puts, first off, understand that the only reason to exercise a put option early is if the interest on the exercise price can exceed the time value. In other words, we're going to get some cash, the exercise price, and if we can throw that into our money market at a risk-free rate, and we're going to earn interest on it, and if that interest can beat the amount of time value that we gave up, then yes, you could make an argument that it was beneficial to exercise. But the point is, it's usually a very small benefit. So the whole idea of exercising a put option early arises under two basic cases. We're going to look at just a long put by itself. In other words, you don't have the shares. But we're also going to look at the case where you have long stock plus a long put, what we might call a protective put, where we buy that put option as an insurance policy. So exercising options, whether we're talking about calls or puts, what we're really doing is comparing benefits and costs. So if you exercise an option, you are going to discard the time value. That's a cost, and that's true whether it's a call or a put. Because if you exercise an option, you throw away that time value. You don't get to close it as well. You get one or the other. So any time value is immediately thrown away. So that is a cost. Now, if you're exercising a call, we might be willing to incur that cost in exchange for a dividend. And if that dividend is larger than that cost, sure, we might exercise a call option early. So for the case of a put, we're doing it to give up this cost, the time value, if we can gain more in interest. So again, the overriding theme that you want to remember is that a put should only be exercised early if the interest earned is greater than the remaining time value. That's really what we're looking at. So here's a kind of a graphical representation. Let's say that this is time, and we've got a $100 put. So if we exercise it, we can get $100 today. If we wait until expiration, we could exercise it and get the same amount. We could still get $100, but we have to wait. So if we can get the money in our hands today, let's say 3 months early, we could invest it and let it earn interest. So you see, it's not really affecting the exercise price. We can always get the exercise price. The question is it worth getting it early to invest it? And that's what's really going to drive the decision. So let's start with a basic case, just a long put by itself. In other words, we don't have the shares. Let's say that the stock is trading at 80 and the $100 put is trading for $20.50. So there's 50 cents in time value, and I've highlighted that in red because that's our target. This is what we're trying to beat. And then there's $20 of intrinsic value. So let's say that the interest rates are 3% and we have 3 months until expiration. So if we exercise the put, we're going to get the strike price or $100 cash, but we're also going to have a short stock position. So remember, whenever you exercise an equity option, that is an option on stock, it is always for the underlying. So if we are exercising a put, we are selling shares. Well, if we don't have the shares, the broker's still going to sell them, and that means we're going to be left with a short stock position. So this is important. You have to understand, are you willing to hold that short stock position in exchange for that cash? That's another cost. So if we take the $100 cash today, we're going to invest it for 3 months, 3/12 of a year, at 3%. So if we multiply all these out, it comes up to 75 cents. So we've earned 75 cents in interest. Our balance would be $100.75. But you can see that by holding the option, there's just 50 cents of an insurance policy. And we can beat that by getting that cash early and investing it. So the basic idea is that puts are usually candidates for early exercise if they are deep in the money. And the reason we have that condition is that's what gives them a smaller time value. See, if this put were trading for $22 or $25, you just know immediately it's not going to be a candidate for early exercise. But if that time value starts getting small, and the reason that happens is it's getting very deep in the money, then yes, it might be a consideration. And then also if we have higher interest rates. Now, sometimes you might think, well, wouldn't it also matter if we have a long time until expiration, because that would also help us to generate interest? Yes, that's true, but if you have a longer dated put, it's going to increase this time value, and that's probably going to kill the deal. So it's usually when they're deep in the money, and if you have some semblance of interest rates, which by today's standards we just don't. So in most cases, you can just forget about it by today's standards. But let's go back to this whole idea of the short stock position. Remember, that's part of the deal. You are going to have $100 cash plus a short stock. You must be willing to hold those shares short during this time. So if we looked at the risk graph for the $100 put, this is what it looks like. Here's our bend at the 100 strike. And here are the negative deltas. So in the example, the stock was all the way down here at 80. And what we're saying is that this put is so deep in the money that if we exercise it and end up with short shares of stock, it doesn't matter where the stock could go. It could come back up to 85, 90, 95. Probably not going to happen. Well, look, you're still on this negative delta portion of the curve. In other words, it's so deep in the money that the chances for this insurance policy to kick in are nil. And so in that case, we might say, yes, I'm willing to hold the shares short. But what if that stock gaps up to 110 or 120? Then you're going to wish you had held that put, because now that insurance policy kicks in. So understand that it's not just about giving up, in this example, 50 cents of time value for the interest. We have to understand there is a reason for that time value, and that's this insurance policy. So just keep that in mind. So now let's take a look at the second condition where we actually have the shares of stock and a put. Would it make sense to exercise here? Well, let's use the same example. Stock's at 80. We've got the $100 put trading for $20.50. Again, 50 cents of time value. But under this condition, when we have the shares of stock and a put, it can get a little tricky. And here's why. If you exercise this put, true, you're not going to have a short stock position. You're just going to sell the existing shares and you will have $100 cash. But look what else you could do. You could sell the stock and get $80, that's the current market value, and then you could sell the put and get $20.50, and that gives you $100.50 to invest. For 3/12 of a year times 3%, you would have a little over 75 cents. Not much, but the point is that in a lot of cases, if you have the stock plus the put, you might be better off just closing them both in the open market. Now, here's where it might be beneficial to actually exercise. If the commissions eliminate any additional benefit, then it might be worth exercising. So let's say that this put we're trading for $20.05 or $20.10, and the commissions were going to eat that up, that extra 10 cents. In fact, it might eat it up to the point to where we end up with less than $100 cash. Yes, in that case, definitely exercise it. So here there's no fear of having a short stock position, but there is a potential for a big regret, because let's go back to where the stock gaps up to 110 or 20 or 50. Yes, we'd much rather have that put expire worthless and still own those shares. So remember, you're giving up, in this case, a synthetic call option. You're giving up all of that upside in exchange for some pennies. So that's why in today's world, it's probably never going to make sense to exercise a put option early. Now let's look at another condition. What if you actually want or desire this upside protection that I just talked about? What would we use for a decision rule here? Well, let's say the stock is at 80. Again, the $100 put trading for $20.50. Well, what you're really doing here mathematically is you are paying 50 cents for the call. That's this insurance policy. You are short stock, long call, and that's what's giving you the put. So if you exercise the put, again, you've got the $100 cash, but you've got the short stock position, and yes, you would have 75 cents in interest. But let's say that we didn't want to leave this risk profile. We like the idea of this upside hedge, just in case the stock does gap up. In other words, we're not wild about having this short stock position. Well, in this case, we might say, all right, to make this equivalent and to compare apples to apples, we would need to buy the same strike or the $100 call. And let's say it's trading for $1.10. Well, now it's not worth it. We'd be better off just keeping the put that has an implied cost of 50 cents for this call instead of $1.10. Now, to be fair, it gets a little tricky here because technically speaking, this $100 call includes this cost of carry. But if we back that out, you can see that there's 35 cents of additional value that we would have to spend for this call. But by giving up 50 cents and gaining 75 cents, we're only picking up 25 cents of additional value. So that's another way of seeing why it would definitely not make sense to exercise and then have to buy the call. So the real decision comes down to, do you want this upside protection? And if the answer is yes, I would absolutely not exercise it early. If you're confident, of course, that raises a question, how could you ever be that confident? But if you're willing to take that risk of that short stock position and interest rates are sufficiently high to where it would make sense to exercise it, it might be an okay time to do it. But you'll find that rarely will it make sense. So whenever you have 0% interest rates, which is pretty much what we have today, there's no reason to exercise a put option early. Now also, little caveat here, the interest rate that we're talking about investing at is the rate that you can get in your account. It is not the rate that you're reading about on CNBC or the rate that JP Morgan gets. What does your broker pay? And that's the rate that you have to compare. So remember, you can always exercise at expiration and receive the strike. That's not the issue. The only reason to exercise a put early is to gain the interest that exceeds the time value. So like a lot of things in options trading, it can be a little tricky, but this is why it's important to understand all of the ins and outs of these decision rules, because early exercise of options is a big mistake among many traders, whether they exercised when they shouldn't have or they missed an opportunity to exercise when they should have. So I hope this helps you to understand the times that it would make sense to exercise a put option early. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.